everyone, and welcome to the Sustainable Finance Podcast, where you can expand your sustainable and ESG investing opportunities with insights from leaders in the field. I'm Paul Ellis, your host for these weekly conversations about developments in this fast-growing industry. My guest today is Rochelle J, Manager of ESG Innovation and Analytics at Trucost, which is part of S&P Global. In this role, March manages, leads, and supports product development and refinement of innovative financial tools for helping businesses assess risk related to environmental and social impacts. As an example of this is Trucost's SDG evaluation tool that provides a quantitative analysis of corporate performance on the United Nations Sustainable Development Goals, that's the SDGs, across a company's entire value chain. Hello, Rochelle, and welcome to the Sustainable Finance Podcast.
Thank you. Happy to be here.
Good. Rochelle, climate risk is a hot topic in sustainable finance just now, and today I'd like to speak about S&P Global's first report to the Task Force on Climate-Related Financial Disclosures, that's TCFD. Many people in our part of the industry know it by the acronym. You led Trucost's analysis and publication of this report, which incorporates looking at climate change risk through carbon pricing risk, or policy risk, right, as well as market risk and physical risk. So please give our podcast audience brief definitions of these three types of risk that companies must evaluate to get the full picture of what climate change risk entails across the entire business model.
Sure. So TCFD provides a framework for understanding how to disclose climate-related risks and opportunities to investors. And within that are transitional risks and then physical risks. And physical risk is acute or chronic. So acute would be some type of storm, a hurricane, something sudden. Chronic would be more related to sea level rise, something that happens slowly over time. And then the transitional, there's a lot in there, and that's more related to institutional changes. So the policy risk would be related to regulatory regimes that would come online and force companies to lower emissions or do something climate related. So this is carbon taxes, participation in emission trading schemes. There's a number of carbon taxes that are coming online in over 140 regions. So this is something that's not only affecting companies operationally, but also in their supply chains. China now has an emissions trading scheme, so does Vietnam. So that's the policy part. And then within transitional risk, there's also market risk. And so that's the risk that a company's customers may have because of climate. And thus, those customers wouldn't be able to buy your products and services. So a good example of this is if you have a lot of oil and gas customers, they may be really impacted by climate because of regulatory or other things, physical. And so then maybe your revenue from those customers would go down. That's something to consider. And then finally, there is technological risk, which is essentially, do you have, first of all, is there a risk to your technology, like data centers and things like that? But also, would you have to heavily invest in technologies to transition to a low carbon future, like renewables? It's very applicable to utility companies that would have to invest heavily in that type of infrastructure. And then there's also reputational risk, which is related to how stakeholders, notably investors and customers, may view a company and their performance related to climate change. If a company's not really doing anything about it and they're considered maybe a laggard, this could culminate in some type of risk.
So let's focus on reputational risk for a couple of minutes here, because that is a big part of what is out in the media, at least, especially since the Business Roundtable made its announcements last August, I believe, and those have been followed, as we all know, by many announcements by specific asset management firms like BlackRock, but also from many corporations as well. In the last couple of weeks, so several large firms in the oil and gas industry have come out with new initiatives that they are rolling out for reputation as well as for physical risks, I would assume. So what is happening today around reputational risk from your perspective that is different from the past few years, let's say?
Sure. So I think this is a really notable time in ESG history. I think the realization that climate risks are quite real and that they're going to affect us very much sooner than companies realized is emerging in the consciousness, the economic consciousness. And you could see that in many of the hurricanes, in the wildfires that hit Australia. And this is reflected in those things that are hitting the investor community, like Larry Fink's letter to CEOs, like the Business Roundtable, et cetera. So I think the investor community has become very aware of these real financial risks. There's the risks of stranded assets related to oil and gas assets that can never be realized because become too hot to burn them. That will really impact these portfolios, and so they're starting to organize around this. And then I think across society, the rise of millennials and younger generations,
as investors,
as investors, but also as customers
and consumers,
purchasers. Yes.
Correct.
There's an expectation that companies are going to be doing something about the climate crisis.
Right.
And that event horizon of climate crisis has just moved closer and closer to us. And now it's pretty, look at the winter this year in New York. It's the warmest winter we've ever had. So the realization that climate will change our lives is more real, and thus people expect companies and investors to do something about it. So that's really culminated to this very heightened reputational component that honestly I haven't seen to this level and across the board as much as it has today.
Yes, I agree with you. I think it's more acute across all sectors of the economy today than it's ever been before. Now, in this TCFD assessment of S&P Global, which was published last August in 2019, you identified 4 elements of recommended climate-related financial disclosures. They are governance, strategy, risk management, and the 4th is metrics and targets. Related to metrics and targets, how did you determine which metrics are most important in managing relevant climate-related risks and which targets are most valuable in assessing the opportunities?
Sure. So I think it was last May, actually, just to
Okay.
But so that framework is given to us by the TCFD. They kind of ask to contribute information under each of those categories. And they do provide guidance on what metrics are important. We did go a bit beyond what TCFD has provided in the past, but some of the basic metrics are, scope emissions, 1, 2, 3 emissions, looking across your operations in that way. We also wanted to look at carbon pricing risk, so how much of S&P's operating margin would be impacted if it had to pay different carbon taxes with different scenarios. So we looked at business as usual, 2 degrees Celsius scenario, which is considered kind of a reasonable target, but also safe, and then 1.5, which is where we'd want to hit, but is probably unrealistic, to see how much that would impact us. And then we also did some metrics on kind of the top sites at risk in terms of a number of different climate change KPIs, like sea level rise, hurricanes, heat waves, et cetera. And then on the opportunity side, we wanted to look at where climate essentially has pushed the company to unlock opportunities in this space. And so S&P is a data provider, provide intelligence and information about what's happening. And so we've developed a number of ESG and climate analytics to fit the need for that information.
I see.
So that revenue that's growing from that business segment is an indication of the opportunities related to this climate transition.
Okay, now you mentioned scope 1, 2, and 3 emissions, right? So I talk to financial advisors and investors every day, and many of them don't know what scope 1, 2, and 3 emissions are.
Sure,
So if you
yeah.
could give them a brief description of what that's about, I think that
No
would be
problem.
helpful.
Yeah, so scope, it's just kind of a way to categorize emissions.
Mm-hmm.
I was reviewing the GHG protocol, which basically is kind of the GHG roadmap for these categorizations. And it's not the most intuitive thing to follow, so I totally get the confusion. But scope 1 essentially would be any direct emissions from a company's operations, any fuel like natural gas used for heating or cooking, in a factory if a company directly operates that factory,
Mm-hmm.
any gasoline emissions from a company fleet, things that are directly emitting. Scope 2 generally refers to electricity. So this is the emissions related to the electricity that a company is using, even though those emissions are related for a utility. So that would be a
Right.
utility scope 1, for example.
Okay.
And then scope 3 is basically everything else. Business travel, employee commuting, emissions from your suppliers that contribute to your products, emissions from the life cycle of your products and services. Let's say you sell a laptop, it would be the end of life of that laptop, all the electricity they're using while someone is after they've bought it, etc.
Mm-hmm.
So there's a number of scope 3 emissions under that category, and not all companies report on all scope 3. I think the most common would be business travel, emissions from waste, employee commuting.
Yeah. Well, I believe in a report that BP put out recently, in fact, a report that their CEO was discussing in the media. There were some questions about the scope 3 emissions that they reported because, as I understand it from that report, scope 3 for an oil and gas refining business includes all the emissions, downstream emissions that people who use their products create. And there are some questions about who's responsible for those emissions. Is it the producer of the petroleum products, the users, the downstream users?
Sure, yeah. I mean, oil and gas does get a lot of the focus, but the whole, oil and gas has contributed to a major increase in well-being and quality of life across the world.
Sure.
And because of that, it's entrenched with many factors of our economy and our way of life. So certainly it's both the customer and the provider. But you're certainly right. The scope 3 emissions for oil and gas completely outweigh anything from scope 1 and 2. And that's really the major impact. Is they're also called downstream emissions.
Yes.
Yeah. So I mean, I could see why BP would want to not count all of that potentially, but that's certainly going to be their largest impact.
Yeah, okay. So climate change, as we've been discussing so far, and the risks are very fluid. And it's a process it seems like it's changing almost day to day in the media, at least. At least from the perspective of physical risks, because they're ongoing and we know when they're happening and how they're happening around the world. Which of these 4 elements are most critical to accurately assess S&P Global's climate change risk in the near term? So let's say for the next 3 years. And please tell our audience why that's so.
Sure. So I think you're referring to those 4 elements, the risk
Yes.
management strategy.
Sorry,
Sure,
I forgot to repeat those.
No worries. So definitely the metrics is foundational, understanding the footprint of the company, how many emissions it has is helpful. But in terms of physical risk, it's definitely looking at where our companies are located, what are the probability of storms in those areas. There's a number of different climate models that show greater or lesser volatility in terms of heat waves and floods and things like that. So I think that's, monitoring that and making sure that there's resiliency plans in place. So, for example, 2017 Hurricane Harvey hit S&P's offices quite considerably in Houston.
Yes.
And so that, fortunately was well dealt with during that period, but now we keep on hand medical supplies at all of our offices.
I see.
Just in case we ever need that. Same with our New York office during Sandy. We now have really strong resiliency plans for all of our data centers. Disaster recovery methods we have, and so there's just an added need to make sure that that goes forward. And then there's one component that isn't quite written out in TCFD especially now, but I could definitely see this rising in importance for S&P and other companies, is the health impacts related to climate.
Okay.
Not just from storms, but from air pollution.
Mm-hmm.
So a really interesting study came out recently that showed air pollution is more deadly than smoking, than diabetes, or violence, even wars. Apparently, it shaves off 3 days of everybody's life globally, if you spread it out. And so we have a lot of offices in India, for example, and so the emissions there are contributing to really bad air pollution that's impacting employee health. So even though that's not what we traditionally think of as a climate physical risk, that is a type of physical risk that I think will rise more in companies' consciousness.
Okay, well, you've just mentioned several different types of risk, and both transition and physical. Give us a couple of additional examples, and they don't have to be specifically related to the report on S&P. Let's talk about the banking industry, for example, or the insurance industry, which are critical to the capital market health on a global basis, right?
Certainly. So, of course, physical risk has a pretty big impact on both of those. Particularly as climate change increases in frequency and severity, because insurance is based off diversification portfolio theory. If something hits in this area, it won't affect this other area, and so you can pay out. But with climate change, it's kind of affecting everywhere. So this is making insurance companies restructure their models, et cetera. So having very good information about physical climate risk, how storms are happening, but also having good information on how companies are prepared for that is really, really important. And in the financial industry, the financial companies may have very low risk in terms of physical risk, in terms of policy risk. Their carbon footprint is very low. Even if there were carbon taxes, it wouldn't affect them very much. But for them, it's really probably around market risk. Probably a lot of their assets and transactions are including the fossil fuel companies, other companies that would be severely impacted by climate change, and who knows what that impact would be on different portfolios and their bottom lines.
Right.
So that's definitely for those types of sectors, it varies. But yeah, for financial, I think market risk would be the largest.
Yes, I did a webinar a few weeks ago with 3 people who are asset managers within the fixed income markets, and we were talking about all of the green bond and climate risk bond issuance that is going on by corporations and governments all over the world, and whether or not there should be a premium in the prices of those bonds, that sort of thing, if they are accounting for specific types of climate risk. So it's certainly impacting the way that the capital markets price assets these days, both equity and fixed income, right?
Certainly, definitely. And it'll be really interesting to see how the insurance industry evolves on this topic, because right now the costs for countries to implement climate mitigation, so lowering emissions and getting electric vehicles online, so expensive. And so and then you're passing that on to the taxpayers, and we saw the riots in France. It's really hard to get these things passed, but what they're not costing out is the risk of not doing this.
Yes.
Basically the lack of resiliency cost. And so I think we'll start to see insurance companies use both and say, okay, you have to do this, or you're going to either not have any type of insurance, or it's going to be, the premium is going to outweigh the cost of actually implementing some of these elements.
I see. Let's go back to regulatory risk for a bit, especially because the level of regulatory risk, or even the existence of it, period, is so diverse in economies around the world. So, for example, in Europe, it's becoming written into the law, maybe in many countries later this year, right? Because there's an extensive regulatory scheme that's essentially being tried out, I guess, in those economies. Now, here in the U.S., we do not have federal regulatory guidance around climate risk, but we do have it in a number of states, and also I believe in the Northeast there's a consortium of states that work on this together, right?
Exactly.
Related to pricing, carbon pricing, et cetera. How do you see that area developing anywhere, really, but on a global basis over the next few years?
Sure. So, I guess two things on the U.S. and then I'll go to global.
Sure.
So certainly a lot of the climate regulatory progress is going to be on the state level. Right now, our political regime obviously is not concerned about climate change on a federal level. Whether or not that's a good idea, we'll see. But a lot of states are really taking action. So Nevada just passed a lot of incentives for renewable energy jobs, for example. They have a lot of sun. It makes perfect sense. Many other states are really, in cities too, are taking this very seriously because they want to make sure that their constituents are taken care of and we are transitioning into a safer future. So I don't think we'll see a lot on the federal level, but I do think we will see and are seeing a lot on the state and city level in terms of that. And then the U.S., as large and powerful as we are, we do trade quite a bit. And so what's very interesting, too, is the EU has started to introduce this idea of charging a carbon tax on any of its imports from the U.S. So Europe is completely leading in this space. And if they did that, then we wouldn't, we would essentially be paying those carbon taxes in any type of transaction with the Eurozone. So all of a sudden, it's not just what federally what we want to do.
Right.
We are part of this interconnected system that's also putting these things online, and we'll see with China too. I mean, obviously with coronavirus, this is kind of delayed or kind of on the back end, but China's been very proactive with carbon taxes and lowering emissions, and who knows if that may become part of the trade talks to put a carbon tax on imports and exports from China into the U.S. as well.
Okay, good. Now, as you were recently a panelist in a discussion on the 2020 outlook for global supply chains, and on that panel you spoke about how investors use ESG, that's environmental, social, and governance metrics, as a proxy for how well managed and resilient a company will be over time. So what value do ESG metrics bring to the TCFD assessment process, if you will, of companies across different sectors of the economy?
Sure. So generally the environmental ones related to GHG emissions are going to be front and center. That's going to be what TCFD wants to know. You're going to start with that. But then there can be many supplemental metrics that prove the point of the resiliency of a company. So let's think about supply chains,
Sure.
as it was in that presentation. Something that'd be really helpful in the S category would be supply chain audits. Looking at how many audits a company is doing, how many problems there were that were addressed. That's going to show that they're in touch with their supply chain. They know what's happening, and if there was an issue related to a storm or that, they'd have touch points, they'd have communication channels, and hopefully a resiliency plan to deal with that. So yeah, I think and governance too. Those high governance metrics show that these companies know what's happening throughout their organization and they're able to report on that, and just having that insight is going to help in the chance of a storm or some other type of climate risk.
Okay, good. Now, what sectors of the global economy are, in your opinion, making the most progress in climate risk adaptation in 2020, and for what reasons are these sectors leading the transition to a low-carbon economy?
Yeah, so I think, any company that's lowering their emissions sizably, either through innovation or operational changes, is certainly contributing. But then also the sectors that will support those companies in doing that. So that's going to be predominantly utility and mobility sectors.
Okay.
Utility offering renewable energy options, infrastructure, mobility offering different types of sustainable transport, whether that's electric vehicles or other mass transit, et cetera. So those are the main sources of GHG emissions. So we need goods companies in those sectors to provide different options. But it's also the information providers, those that are giving the monitoring and the data so that these companies know their impacts, know what's going on, and where to focus. And then finally, this is a really small part of the global economy today, but I think will grow quite a bit, is kind of these remediation technology sectors. So anything related to carbon capture or soil remediation, waste management, things that are going to sequester carbon or kind of regenerate natural carbon sinks or other things, even the ocean, for example, to help us adapt in that way as well.
Right. I was at a conference in the fall on various types of carbon reduction processes, and there were several climate scientists there who were talking about carbon capture and storage as really a critical part of the future of how we're going to deal with the carbon issues, and they were expressing at that time that we just need another decade or so of time to really refine these technologies and get them scaled up. And so that's what the SDGs are telling us, I guess. We have a decade left to be working on these issues. Well,
Definitely.
Rochelle, I really want to thank you for spending time with me today. There's a lot more to talk about, obviously, in this area. But I really appreciate you visiting with me and the Sustainable Finance Podcast. Now, how can our Sustainable Finance Podcast investor and advisor viewers reach your team at Trucost with questions about this TCFD report specifically, and what other information about Trucost can they find on your website?
Sure. Well, thank you so much, Paul. This was a pleasure. So I think Trucost info, I think at spglobal.com.
Okay.
And then there's trucost.com, but you can also go to S&P's website and look up the ESG solutions, and we contribute to a number of those.
And what if folks want to get in touch with you directly for specific questions about what you're doing and you and your team are doing here at Trucost?
Sure. Well, my name is quite similar to my email. It's rochelle.march@spglobal.com.
Okay.
So I'm happy to be available for that.
Great. All right. Well, for our podcast subscribers and listeners, please join us again next week for another episode of the Sustainable Finance Podcast, as well as quarterly sustainable finance webinars, which feature panels of sustainable and impact investing experts like Rochelle March, in dialogue about important developments in this industry. I'm Paul Ellis, your host for these podcast and webinar programs, and this is the Sustainable Finance Podcast.